Welcome back to House Rich, the real estate show, home of the world's best home buying tips. Today we're going to talk about 7 things I bet you don't know about an FHA loan. And if you do know all 7, drop a comment down below. I'm curious to see what percentage of the community actually knows these 7 items. And no cheating. So if you know, who am I? My name is David. I have 7 years of expertise in the mortgage industry as a loan officer and an underwriter. So let's jump into the topic. So number 1, a common misperception is that you can only have one FHA loan at a time. There's actually scenarios we can have multiple FHA loans at a time. And these scenarios are, 1, if you're relocating due to a job, you're allowed to get another FHA loan. And so one of the stipulations is that this property has to be at least 100 miles from your current FHA property. You can't be just say, I'm in Dallas and I'm getting a new job in northern Dallas and I want to get an FHA loan. No, it has to be at least 100 miles away from your current property. Number 2 is if you're growing your family. So let's say you're in a single family home right now and it's like you and a fiance. So technically per FHA guidelines, a fiance is not, they're just another person. They might as well just be a roommate. But you're in like a 2-bedroom property or something like that, or even a 3-bedroom property, who knows? Oh, let's say 2-bedroom. And so let's say you get married and you have a kid. So you've gone from a family of 1 as far as the FHA is concerned to now a family of 3. And so you may need a bigger room, more rooms, more square footage in that property. So like in that scenario, that's something you can easily prove and say, hey, I got my property in 2019. I got married in 2020. And then I had a kid, later that year. I had 1 family member at the time. Now I have 3 family members. You're growing your family size. You need a bigger space to live. So that's cool as far as the FHA is concerned. Now let's go to the other side of this. Let's say that fiance, now wife, divorces you. So if that fiance is or that wife is keeping the property, you're allowed to get another FHA loan as well, because that's not going to be your primary residence anymore. So you still technically are part of that FHA loan, and it'll still be kind of toward your detail and all that if you're still on the mortgage. But you can have that FHA loan and still get your own property using another FHA loan, because once again the FHA loan is for primary residence. So you're divorced and you're not living there anymore, unfortunately. Let's say you were helping somebody out on an FHA loan to help them qualify, and you were just like a co-borrower. You're not actually living in the property. You can go on and get your own FHA loan. Once again, all the same debt-to-income ratio guidelines apply because you're attached to that mortgage as far as the lender is concerned. So it still counts towards your debt-to-income ratio. But you can get another FHA loan. And let's say you're these last 2, I wouldn't bank on these, but there's stipulations as well. But if you're just getting another property and you're technically not building your real estate portfolio somehow, you can get another property. Or if you're buying like a HUD-owned REO property, you're allowed to get another FHA loan as well. And so one of the stipulations of these is one for like the growing family size, you have to have at least 25% equity in the property. And for the other scenarios, you have to have at least 75% equity in the property, which you may say, whoa, that's a lot of equity to have in the property. That is a lot of equity to have in the property. True story. But once again, the FHA is designed to be a primary residence loan. And so, if you want to use FHA loan again, you have to kind of abide by those guidelines. And we'll jump into a little bit more on when and I think you should and shouldn't use FHA loan as you go through this list. So that's number 1. Number 2, so the FHA loan is not just 3.5% down. I always hear folks say, hey, FHA loan 3.5% down. It's actually not. So you put down a 3.5% down payment, true story. But there's also something called the FHA or the upfront funding fee, which you have to pay 1.75% of the loan amount. So let's say, for instance, you got a $100,000 loan. 1.75% of that is $1,750 you have to pay as well. So the reason a lot of folks don't think about this or know about this is that you have 2 options with the upfront funding fee, and the lender usually doesn't even suggest both of them. They just tack it onto the loan amount and finance that $1,750 and so essentially gets added onto the loan amount. So you don't pay it up front unless you want to, but essentially you're paying it when you sell the property because it's an extra 1.75% that's added to the loan. So you're paying that plus any interest as well, because it's accumulating interest as well as part of the loan. So something to factor in as well is that upfront funding fee, which is just money that you're being taxed and won't get back again. So those are 2 so far. If you've got value, hit the like button, subscribe, tell a friend to tell a friend. But let's get into number 3. the FHA Self-Sufficiency Test. So FHA loan is great for house hacking. You know, you can put down 3.5%, whether it's a 1, 2, 3, or 4 unit property, but you have to pass the FHA self-sufficiency test for that 3 and 4 unit property. So what does that say? It essentially said that your mortgage can be no more than 75% of the rents on the property. So let me break that down for you real quick. Let's say you have a 4 unit property and the rents are $1,000, $1,000, $1,000, $1,000. Your mortgage can be no more than 75% of that, which is $3,000. And so let's, even a scenario where it's like, let's say the rents are $2,000, $1,000, $500, $500, and it still adds up to $4,000. And let's say you're in the $2,000 property for some reason. That doesn't matter. It's just what the total rents are. So it doesn't matter what property you're in or what's vacant or anything like that. And so that's super important to know as well, because you need to make sure that your lender knows about this, you know about this, and your realtor knows about this, because you don't want to be going around looking at properties that you can't even qualify for when it comes down to the FHA self-sufficiency test. So once again, your credit doesn't matter. You can have 800 credit score. Your income doesn't matter. The DTI doesn't matter. Like, you can have a 3% debt to income ratio, but if it doesn't pass this test, you're out of luck. And so one thing, especially like a lot of high cost of living areas, is that folks end up having to put down more than that 3.5% potentially to lower the principal, the mortgage payment, which is your principal, interest, tax, insurance, and association dues as well. So that's something to factor in. How much you have to put down for that property versus the minimum down payment or maybe another program. For instance, like if you're looking at a conventional loan, for a duplex, some lenders will have like a 5% minimum down payment, no FHA sufficiency test. So if you're looking at an FHA loan, it's like, hey, FHA loan, I may have to put down even 4.8% or 4.5% or more than that. You may want to weigh your options, and it may make sense to just go conventional loan in that scenario, because like I always say, unless you have bad credit and can't qualify, or you're house hacking and you can put down that 3.5%, it really doesn't make sense to go conventional. And so we'll get into that a little bit more as we go down the list. Actually, we'll get into that right now. So let's talk about the amendatory clause. So what the amendatory clause says is that if the home does not appraise for the price on the contract, the buyer can walk away at any point in time, even if it's one day like before for closing. So let's say for some reason you get your appraisal back 2 days before closing, or I guess technically you can't get it back 2 days before closing, or I guess you can, but let's say you get it back 2 days before closing for some reason, and the purchase price is $300,000. It comes back at $2,999, and you really didn't want the property anymore, but hey, you didn't want to lose your earnest money. You were having second thoughts. You can just back out and walk away, and you'll get your earnest money back. But let's say like a more realistic scenario where it's like, or maybe not realistic in this environment, but let's say the purchase price was $300,000. It came back at $275,000. Then that puts you in a great position of negotiating power as well, because the seller pretty much has to come down, or you'll walk away, and they'll risk putting the home back on the market. And here's the thing about putting the home back on the market. That appraisal, that $275,000, that appraisal is attached to the property. So the next person that uses an FHA loan knows that it appraised for $275,000. So it puts you in a great position as far as negotiating power to get them to come down a little bit closer to your pricing. Let's say you guys might settle at, I don't know, $290,000, $285,000 or something like that, where if it was a conventional loan, you have a lot less wiggle room because you don't lose that earnest money, which is a big deal there. And so the other side of that coin is sellers, realtors, or at least decent ones, know about the amendatory clause. So all things equal, if a conventional offer that is at least close to FHA offer will probably always beat it due to that amendatory clause. So just kind of FYI. Number 5, the PMI, hopefully you know this, the PMI stays on the FHA loan forever. Unless you're putting down like 10% initially on the loan, that PMI will stick with your loan forever. So once again, unless you're house hacking and can't qualify due to bad credit, you might as well just start with a conventional loan, because you're going to have to end up paying those title fees all over again to refinance the loan into a conventional loan and drop the PMI. And who knows where rates may be. You may be at that 20% equity point, but now rates may be higher, and it may not make a lot of sense to refinance. So you always want to start with the conventional loan, if it makes sense to do that. And then number 6 is that it actually has the highest down payment. I always hear folks talk about, hey, FHA loan, low down payment, blah, blah, blah. No, let's think about this. Let's break this down. So you have a VA loan, which is 0%. You have a USA loan, which is 0% down. You have a NACA loan, which is 0% down. Conventional loan, your minimum down payment for a conventional loan is 3%. Then we go FHA, 3.5%. So it actually has the highest down payment of any of the loan programs. Number 7, super important, because this can kill a lot of deals. If you're in a community property state, even if your spouse is not on the loan, your spouse's debts are added to the loan. So let's say you've been thinking, hey, you kind of run the numbers yourself. Hey, my DTI is, I don't know, 37%. I'm good to go. If you kind of crunch the numbers, and you're like, hey, no, I'm not going to put my spouse on the loan because her credit is bad. Well, surprise, the lender still will pull your spouse's credit. And if the credit is too low to qualify for the loan, unfortunately, the income will not count, but the debts will be added to your debt. So you have to make sure that that's something that you're factoring into your decision-making process as well. And so what are the community property states? Well, they are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin are your community property states. And so if you're not married, you may have to make, it's like a fiance situation, you may have to kind of make decisions, say, hey, should we buy a home earlier? Should we maybe push back the wedding because they may prevent us from getting a property? And so see my other video as far as, building the ultimate real estate portfolio, to why it may make sense to wait to purchase properties before you're married as well, because it'll help you build your real estate portfolio. So that will be somewhere around here if you're watching on YouTube. So there you go. Hope you liked the video. If you watched this far, subscribe, like, tell a friend, and let me know what other stuff you guys want to see. Thanks.